Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in, take a look what's going on. You can follow me at Finance, and you can join our community, finding-value.com. I dive deeper into all these topics, sectors, looking for potential investment opportunities, sharing them in the community. You can see when I purchase things. We do Q&A sessions. You can ask me directly what's going on, what I think, why I made a good or bad call. You can ask me whatever you want. On the weekends, Saturday and Sunday, we hold those. I also give midweek updates on the individual companies and the charts, what I'm doing, what I'm buying, and sharing that with everybody. We do have a coupon code special, is that coupon code, and it works both for the monthly and yearly membership. You only get a first month discount on the monthly membership of 50%, and you get a larger discount on the yearly membership if you'd like to join. So we got unusual whales reporter. The Chinese continue to say that the U.S. and Chinese are not engaged in any consultation or negotiations on tariffs. Can you clarify? Dissent. We're not going to talk about who's talking to whom. Not confidence inspiring, guys. I believe Dissent came out and said that they were in negotiations with China, and they said, "Hey, well, who's negotiating? We're not going to talk about that. Shut it down." I'll just say it's not confidence inspiring to hear things like this because I've read other things from Dissent saying that they were in negotiation or speaking with China and working on whatever. I don't know. This seems like he's backtracking. It seems a little bit fishy. That's all I'll say. Buffett on recent market volatility. What's happened in the last 30, 4,500 days, it's really nothing. There have been three times since we acquired Berkshire when the stock went down 50% over a short period of time. And in each of those times, nothing was fundamentally wrong with the company. This recent move is not a huge one. Well, I know a lot of people they're talking about a 1929 style crash, the Smoot-Hawley tariffs being implemented, and they're trying to run parallels between that time and today. I don't see the parallels, guys. I don't see it at all. Yes, there's a tariff that's put on. Yes, the Smoot-Hawley tariff. Yes, they are tariffs by name. But the 1929, I mean, in the 1920s, we had a massive, massive problem in real estate. Major deleveraging, major deflation coming from the banking sector on a buttload of bad loans. A buttload. We don't have that, at least in the retail sector. And I should say retail bank lending or the residential real estate is what I meant to say, not retail, but residential real estate. Residential real estate makes up roughly 70 to 80% of all home loan value in commercial banks in terms of loans going out. Business loans are far, far smaller. And then it's even the commercial bank loans, for commercial real estate, they're smaller too. They're not nearly the same size as retail. And the big hit comes from residential real estate because there's a lot of employment around residential real estate. There's also a lot of money coming into the system and flowing through the system with residential real estate transactions. Commercial real estate, it's like rich guys taking a loss. It's not your average Joe taking a loss on commercial real estate. It's rich guys buying buildings and selling them at 40, 50, 60% discounts. I don't think it will impact or have the same amount of impact that residential real estate has. I'm not saying it won't have an impact. I'm just saying it might not have the same impact that people think. Now, 1920s, they were giving out ninja loans, no income, no job. They were flowing, they were chucking loans to anyone out at that time. Does that sound very familiar to the mid 2000s? It's the same exact setup. The deleveraging event that occurred in 2008, 9, 10, and 11 with all those bad real estate loans was very similar to the 1920s. So if you want to run a parallel, in my opinion, those two Time frames had the same conditions, crappy loans. Now we've got gigantic amounts of equity built up in the majority of these homes. Hardly anyone's underwater, and you don't have any of the crap loans. Those are not the same conditions, guys. To even compare these two, it kind of blows my mind. Now, could there be a downward, recession or some problem given the tariffs and all this? Now, I'm not stating that we can't have that. I'm just stating that the conditions of the 1920s is nowhere near what we have today. It would have been a better parallel between the 2000s and 1920s than today. The CEO of Ford telling you straight up to expect massive price hikes and massive shortages. Says a lot of parts like fasteners, washers, carpet, wiring looms are just not available. We can't even buy those parts here, says Jim Farley, the chief executive of Ford Motor. Automakers and suppliers say it will take years for them to relocate assembly lines, and they are unlikely to commit billions of dollars to domestic manufacturing because of the uncertainty about the direction of trade policy. Mr. Trump has frequently changed his mind about the size of tariffs and how they should be applied. On Tuesday, he modified some of the rules to allow automakers to avoid paying duties on a portion of the components they import for 2 years. The measures provide the industry some relief, but car prices will still rise by thousands of dollars, analysts said. This is you can't just pick up a facility and move it and expect it to run very quickly. It takes years. I actually did a couple of moves where we moved one facility to another, and I was the head guy, one of the head people doing it. We had the director who was basically doing all the math behind it, the finances. I was on the engineering side, physically making a lot of these moves, not just physically, but prepping things to move. I was on the moving side and the reception side. So I came from the facility and I was going to be the one that was going to oversee it at the facility. And I was the one who ran the movement from one facility to the other. And that took us this was very simple manufacturing, but there's a lot of regulations, there's a lot of things that you need to get into place, and we already had the facility up and running. So we had two facilities that were up and running, and we moved them to an existing facility to consolidate and save money that way. If you have to build new facilities and then all the rules, the regulations, it's going to take 5 years at least because you got to build the facility. That'll probably take a year if it's going to a new facility. Then you got to get all the regulation, all the stuff going through. If there's emissions, it'll probably take a year just to get your emissions all squared away and all the permitting and all that crap because that's going to take a long time. You got all the safety rules. You have to buy all the equipment, get all the equipment, bring it all in, lay it all out, figure out how to lay it out, do all that crap. Then you're going to have to implement all the systems, the um, manufacturing ERP system, all that crap. So if you've got stuff changing daily with the size of the tariffs and exceptions and rules, yeah, it's probably going to take a year or two just for these guys to figure out and stabilize what the tariffs will actually be. Because I was just reading a couple articles that Trump's probably going to reduce the tariffs on China. So it's like, well, this all needs to be solidified before anyone starts putting shovels in the ground to build new facilities, in my opinion. Sure, a couple may come back. Sure, they might have a few, but for the majority and the bulk of it, if we really want to move it back, you got to have stability around what the expectations are. Here's Z4 Energy Research. Chill, baby, chill. This is active frac quarter average. So you can see fracking. Fracking. This is what they do when they basically you have a drilled uncompleted well, and then you frack it, and then you produce from it. And you can see that this is coming way down. Uh, more than likely, we're going to see a reduction in production at some point here. Markets and Mayhem says big declines in oil often signal recessions and or relative peace. Not so sure we're seeing a lot of peace. So he's saying maybe we're in a potential recession. And we really got the big kick lower with the tariff information. When they came out, that's when we really kicked lower. The big question is, where do we bottom? What does the bottom look like? Have we already potentially trying to bottom here? And that's where everybody's going to take their guesses. And in my opinion, this fractal, I call that a fractal. That fractal is similar to the 2000, 2001 pullback. Um, that's kind of where I'll say where my head is at. I think from a fundamental perspective that everything still looks pretty dang solid. And that's kind of my opinion of where we're at. And so this big move here is this move right there. The reason I think that's the case is because we look at let's say the commodity to stock ratio here. We're at this undervalued location. And here it was 2000. We came up, 2001 was this, there's a little pullback in here. It's not in the commodity stock ratio, it would be in oil. But this is the move coming on up. The last bull market, this was a big bull market here in the 70s all the way to 1980 peak. And we're down here in no man's land in terms of valuation. It's probably one of the cheapest times in the last 100 years in terms of commodity to stock ratio. So I think that we're early in the bull market. And that's where I base a lot of my opinions around, is based off that. So when I look at the oil chart, we get these big three hump consolidations. We had a three hump consolidation 1, 2, and then 3, and it ended in 98, 99. We had a big up move. And then we have 1, 2, 3 hump consolidation in a falling wedge that's broken out, and we're doing the retest right now. And then we're going to get a big move in oil out in the future. It'll be down here will be one of the best investments that anyone can make in the oil markets given history. It'd be like buying it in 2001 and riding this entire move up. That is what I think will come out in the future. There's other information too. When I look at like total inventories, things don't make sense. Is what I'll say. So when I look at this, I'm going to pull up another chart real quick. This is your total U.S. oil inventory. Last bull market from 2000, 98, 99 coming up. You can see the total U.S. inventory was increasing all the way up into 2008, where 2008 it peaked. We've been declining in our inventory. We are actually the same inventory as we were in 2004. And, and in 2004, we had much less demand. So if we have much less demand, that means our days of coverage is far lower today than what it was back here. So is the market pricing something in where we're going to get a lot more inventory of oil? My guess is no. My guess is that I think that they potentially have it wrong, potentially. And that's where I get some of my bullishness from. Scrolling down into the stock markets are bouncing, gold is correcting. Does this change anything? No, it does not. Here's the latest up-to-date Dow versus gold analysis, and I'm just going to keep moving this around so you guys can see everything. So one of the early bull markets in commodities was in the 30s. That was a revaluation of gold, where they went from, I think it was $20 an ounce to $35 an ounce. And that revalued all commodities higher. Same thing happened in the 1970s. We had a peak in the late 60s, mid 60s, and a huge decline in gold outperforming the S&P 500. We had another one where it peaked out in the early 2000s and rolled on lower. We already have a breakout right now, breaking lower, where gold's starting to outperform the S&P 500. This is the commodity bull market. And if you combine this chart that I show here with the commodity to stock chart, and you kind of add these things up, and that's the chart I'm talking about. You add the relative valuation here and the gold outperformance breaking out of the SPX, that's your commodity bull market. That is the two charts that hold massive weight of what is coming in the future, in my opinion. So here's Buffett. He says, nobody knows what the market is going to do tomorrow, next week, or next month. And nobody knows what business is going to do tomorrow, next week, or next month. But they spend all their time talking about it because it's easy to talk about, but it has no value. No value at all. A lot of YouTube channels talk about this. They're talking about all the projections of where the market's going to go, what it looks like, and all those things. And in his opinion, it has absolutely no value. Now, what does have value? It's the valuation in relationship to price. And that's what that commodity to stock ratio tells us. You can also use some things to see how things are changing market condition wise, like gold outperforming the SPX. I do think that has value on the longer term, bigger picture view. It does not mean that your investment is going to go up next week or next month. I agree with that. But you need to get some sort of orientation in the market of where the value is. And that's all you need to do is look at the ratios and say, yep, this is cheap compared to history. I'm going to buy it and then hold on to it. Now, some people say, well, it can stay cheap for a long time. That is also true. It can stay cheap, but what's your other option? To go buy the overvalued asset? Is that what you're going to try to do? And you're going to try to make money in an overvalued asset that could crash at some point? At least historically, the undervaluation or overvaluation always correct itself over time. Here's Ronnie. He says, is gold too expensive? Triple top ahead. Well, it says this will answer the question. This is hours of work to buy 1 ounce of gold. We had a massive undervaluation in the early 70s, early 2000s. And then we've got these three very high levels of hours worked to buy 1 ounce of gold. Is this a peak, or do we break out and move higher where everything just becomes unobtainable? I'm in the camp that we're going to break to the upside. Why do I think that? What makes the case that this will break to the upside? So what I would look at is I'd look at the commodity to stock ratio, and commodities are far, it's way underpriced. I would then look at your gold to stock ratio or financial assets, and that is underpriced for gold. Then I would look at other things. I'd start looking at, let's just go back. We've got gold to stock or financial assets. We've got commodity to stock ratio, which is cheap for commodities. Those are those couple of things there. The next thing I would look at is gold is priced in dollars. And then you want to look at what is the valuation of the dollar. And you think that the value of the dollar is going to go down. The value of the dollar is going to go down, in my opinion. You can do Canadian to USD, Australian dollar to USD. You can do all of those. Great British pound. I think all the other currencies are going to outperform the dollar, which then makes me think that the dollar is going to get weaker. If the dollar is going to get weaker and you're pricing gold in dollars, that's what's going to cause the breakout. Someone also said that this is a cup and that this is a handle. It's a big cup and handle. It's a continuation pattern. You also have technicals stating that is going to move on up. Another thing that is good for gold to break higher is this era, this entire era when it was coming down. This was gold being controlled, so you can't really use that. X that out. This was an increasing interest rate environment here, and then the cup and handle that this is in was a declining interest rate environment. That changed in 2021, which is right in this section here, and then you can see we're moving on up. That is another tailwind created by the markets for gold. The tailwind is an increasing interest rate environment, which means money is leaving the bond market, and it could be leaving the stock market eventually, financial assets, which ties into this chart that we just went over here. It's going to start to leave financial assets and enter gold, silver, platinum, and other hard assets. This is all money rotating. And all of this that I'm showing you is all interconnected. It's not one chart doing one. It's all interconnected. So this is going to rip way up. People in America are most likely, the average person is not going to be able to afford an ounce of gold, not even close, out in the future. They will not be able to afford it. So your best chance in history was to buy it in 2000, was to buy it here in the 2010s, or this is 2011, but 2010s here, and even 2020. And it's probably still a great time to be looking at purchasing metals before they get to unobtainium status for Americans trying to buy precious metals with currency that's been shredded in terms of its valuation. The decline of the purchasing power of the dollar is going to be the main driver of the hard asset move going up. Now, I can't tell you the exact timing. Are we going to do more stimulus? Are we going to, is it going to be driven by our debts and the interest payments on those debts? I think it's a combination of all those things. I think they're probably going to save the bond market, and they're probably going to do QE, and then they're going to just absolutely torch the dollar. And that's what I think they're going to try to do. What we're seeing is we're seeing interest rates go up at the same time that the dollar is going down. That's also another indication that people don't want dollars and they don't want the bonds of American paper, we'll call it. This thing's going to rip. It's going to go. And silver's gonna light it up, guys. Silver is going to light it up. Buffett on the recent stock market volatility, it's really nothing. Buffett said this has not been a dramatic bear market or anything of the sort. Age 20 to 30, people don't invest because they're trying to enjoy their lives. Age 30 to 50, people don't want to invest because they have a family to take care of. Age 50 plus, people start wondering why they can't retire when they originally planned. Don't let this be you. So what I did, and I'm not saying what I did was perfect, but I front loaded all my savings when I first graduated college. I went and I started working, and I just started saving everything. I saved hundreds of thousands of dollars before I was 30 years old, and that set me up even for where I am today. I'm in my early 40s, and yeah, I mean, it set me up very well doing what I did, and I can tell you why I did it. I did it because I didn't like working my engineering job. Even in my 20s, when I first started working, when you're the most hungry, the most, um, I should say, when you first come out of college, you're supposed to be the most hungry, and that should be the most enjoying time of your career, one of the most enjoying, let's say. No, I hated it. So I kind of went into engineering just because I was really good at math. And I basically, in all the classes I took, I was always like top one, two, three. I went to a pretty hard school too, I guess, high school that is. We had a lot of people go to really, really good schools. But I was really good at math, and basically I'd get maybe a couple problems wrong an entire class. So if we had, say, calculus or something like that, I'd get like a couple problems wrong in the entire class. And they said that a lot of people said I should go into like mathematics or physics or some sort of like engineering or something. So I just decided to go into engineering. And I don't know. I didn't really. I mean, I like playing with things. I like hands on. I like rebuilding motorcycles. I like tinkering with cars. I don't know if engineering was the best fit, but then again, I didn't have any other, I didn't know what else I wanted to do anyway. So yeah, it makes sense. Here's the end game. So Buffett's currency comment wasn't casual. It was a sovereign signal. Let's just talk real quick here. There's a lot of verbiage here. I'm going to try to sum it up. What he said, quote, at the last Berkshire Hathaway meeting, he says there could be things that would happen in the US that would make us want to own a lot of other currencies. What he's hinting at is that commodity bull market that I'm seeing, the valuation of the dollar dropping, emerging markets starting to outperform. It's all interconnected. And I'm glad Buffett's coming out and saying this stuff and kind of just saying, hey, this is what I see in the market. This is, I'm going to kind of go past some of this stuff. What Buffett could be signaling is a sovereign grade dollar risk. He may believe that the US policy decisions, whether fiscal, monetary, or political, are now posing structural threats to the dollar's trustworthiness. And it could include a looming treasury market crisis, which is your bond market, or a loss of foreign confidence in US debt, weaponized monetary policy leading to stealth devaluation, political instability or regulatory dysfunction, creating capital controls risk. Regime fragility, not just inflation. This isn't a repeat of the 1970s style inflation hedging. Buffett isn't recommending gold. He's implying that owning dollars themselves may no longer be safe in all scenarios. That's a fundamental shift. It's the kind of concern that normally triggers sovereign portfolio rebalancing, not just corporate hedging. So, strategic positioning for multipolar finance. With BRICS countries accelerating de-dollarization and U.S. trade tensions heating up, Buffett may be preparing for a world where global reserves and trade invoicing fragment. In that scenario, exposure to other currencies isn't opportunistic, it's essential to preserve purchasing power and operational sovereignty. So that's kind of what is going on in Buffett's opinion. And I think this guy's trying to break it down and what Buffett might be thinking. So I'm going to kind of go through the rest of this. Michael says Warren Buffett's edge wasn't being smarter than everyone else. It was managing behavior in scary markets and buying good companies and holding them over long stretches. That's it. That was his secret. Buy and hold. That is his secret. You don't have to be the smartest. You just have to find good companies in scary markets and buy them when everybody else is selling them to you. And then you just hold on and don't do anything else. It's really that simple. The hard part is people get scared. It's a genetic trait inside of you where you're pressing on buttons that is like your primal instinct. When something is bad or something is presented to you where you get a large loss, it makes you want to extinguish that loss by selling it out of the portfolio. You don't want to see it. And that's where the emotional control comes in, but it's much easier said than done. Some people are going to say, well, how do you gain that emotional control? How do you master your emotions? I think the first step is being aware of what is going on, just being aware of it, being aware that most people sell during max fear, understanding and looking for what fear looks like. I mean, all of that is important. Once you start to figure that out, I think you can outperform the market quite easily. You just have to be patient. But then again, there's a lot of people who are not patient. Metals and weekly price, we have uranium killing it last week compared to everything else, up 4.5%. Palladium up a little bit, 1.54%. Molybdenum, tungsten, and then we've got our losers, tin, copper, lithium, and silver had some pretty big pullbacks last week. This is another Warren Buffett. For some reason, there's a lot of Warren Buffett quotes here, but nobody buys a farm based on whether they think it's going to rain next year. They buy it because they think it's a good investment over 10 or 20 years. It's the same with stocks. Think of stocks as part ownership of a business. It's not that complicated. This is the Saudis. We've got a lot of chatter about Saudi increasing production. So this is coming here, and it's a little bit different message than what we've been seeing in other mainstream medias. So this is what it says. Saudis warn of more supply unless OPEC plus cheats fall in line. So I think what they're doing is Saudi is threatening the people who are cheating on their production. They're saying, look, guys, if you don't fall back in line, we're going to flood the market and we're going to drop the price. So that's a way different message than Saudi coming online with more just to bring it on. I don't know the exact. This is what I'm seeing. Of all the news that's out there, I don't know what's right and I don't know what's wrong. I don't know if they are legitimately coming out with this news and telling us exactly with the right frame of reference what this information is. I'm seeing all these things specifically related to Chinese and tariffs and how we are communicating with them even though we're not. And then this whole everything around oil is like this huge question mark. It's as if somebody is trying to push the price of oil lower. And Besant and Trump, if you listen to them, Besant just recently said, he said, hey, you know what? If you looked at the oil price, if you looked at the gas price, it's almost like these guys are trying to push this thing lower. I don't see the bearishness anywhere else. I don't see it in the conference calls. I don't see it in the inventory levels. I don't see it in production numbers. Like, what's going on here? All I see is this news, and these news, none of it matches. So Saudi warns of more supply unless OPEC Plus cheats fall in line. And it says Rida steered the Organization of Petroleum Exporting Countries on Saturday to agree on a surge of 411,000 barrels a day in June. The second month in a row, a bid to punish the quota cheats like Kazakhstan and Iraq. So I don't know what's going on here. I just want the same message. I just want to know what is legit and what is false news being released. Global food prices are on the rise again. You can see that kicking on up. And, I think fertilizer is going to do quite well here. If you look back here, this is your three hump consolidation: one hump, two hump, three hump, and then you can draw a trend line through that. You draw that trend line through that. We've broken up. That's your first big wave. I think this is wave two pullback, and I think this is the beginning of what could be a very, very big move. A lot of the times, what happens is you break out of this consolidation, so you break out, and then you get a retest. This is your retest, so to speak, in this zone of support. So we got our retest in this zone of support here, and now we're going to rip it. I don't know how high we're going to go. It depends on the value of the dollar as well. If the dollar drops, I think food, which is priced in dollars, is going to rip. A lot of good investment opportunities based around this. Here's another one. Gold's in a bull market for at least the next 3 years. This means that I should buy the gold juniors that are currently trading at a PE of 2 to 3 and wait for a 10 bagger, which will come in 3 years as gold hits $5,000 an ounce. Yeah, I don't, you know, I'm not in that camp. What I would do is I would take everything with a strategy. Like, what approach are you trying to take the markets with? Do you need to take on the risk of gold junior companies? Would I own some gold junior companies? Yes, I would. I would own some for sure. Your portfolio allocation is really what you have to start to look into. And almost everyone, this is what they do. A lot of people, they'll look at the market setup. They get bullish in gold, and then they're like, "Oh, I'm just going to dump all my money in gold junior companies." It's like, okay, that's a lot of risk to take. Even though I think that you're probably right on the call of gold. So, how much risk do you need to take? If you don't need to take much risk, if all you want to do is, let's say, protect your wealth and grow it a little bit, then physical gold or physical silver, or a combination of those two things, is good. And what you're doing is you're going to lower your risk by holding the physical metals versus gold juniors or gold mining stocks or whatever it is. But I do think that there's some place for gold juniors. I just don't think that the allocation that most people put to it. I I just think they're dialed too high on it. That's all. Here's Grady. He's talking about silver here. We'll do a quick one on here. It says the precious metals bull will last many more years, so do not get beat down by the declines or lose interest during them. Understand them, be ready for them, and whatever one does, keep your eyes on the big picture. Most play the market with their emotions. They react to everything, plus have no strategy or trading investing rules of their own. They do the same thing over and over without changing. To succeed in trading investing, it is vital not to participate in this recurring emotional roller coaster, but make use of it instead. And it is then, when gold and silver are in much needed consolidation pullback, that one needs to plan for what to do when this sector bottoms. If you do not understand the sector movements, plus do not get mentally ready for what's coming, you will get again not be ready to buy the lows. Then you will yet again buy the sector is already up hugely. The market is not the major hurdle. That is the easier part. The more complicated part is to get right in order to succeed with trading investing is ourselves. And most cannot understand this or change by themselves. Most need help with understanding how they work with regards to trading investing, plus the changing their behavior and thinking. So this is the mother of all legit looking probable cup and handles. Silver has that big cup and handle. It's ready to break out. It's driven by the increase of interest rates, in my opinion. This will rip, guys. And it will rip so big and be such an opportunity that you could literally just buy the physical metal, sit it in a freaking corner of a room, and just let it go. That's it. That's all you got to do. You just got to get in there, sit, and do nothing. I think that this is going to be a function of a declining dollar, and increasing interest rates means money is leaving the bond market. And if interest rates get to a certain level, I think they're going to start to leave the stock market as well. I think that that could potentially lead to gold and silver and other precious metals too, platinum and palladium and maybe even rhodium, to go to levels that are ludicrous, ludicrous levels. Um, does that make sense? So here's an important thing. You need to have a incredibly bullish outlook beginning of the bull market to load up sufficiently in for this outcome. You can't be like, oh, it hasn't really moved. It hasn't broken out yet. It hasn't done this. And then it breaks out. Well, I still have some time to buy it. And all of a sudden it's at $75 an ounce when you could have been loading up at $20 an ounce. That you have to be bullish when everyone else is bearish to get the maximum out of these big markets. I'm not in the camp that I'm going to wait for 800 horizontal lines to break. That's just not how I operate. I buy value. I was buying the living crap out of silver in the I started buying it in 2018. In that time frame, I bought it a little bit before that too, but I started buying in mass in 2018, and it was 14, 15, 16, 17, 18, $19 during when I was purchasing a lot of these things. So that's when I loaded up, and I'm just going to sit. I'm doing the same thing with gold. I still have a good chunk in gold, and platinum I think was absolutely ludicrously priced for a good chunk of this. So that's what I'm doing. These patterns are so big that when they take time to break, it takes a lot of patience. To me, it's not even patience. I don't even look at it. It's like, okay, I got silver, and there were some people I purchased, individuals I purchased a bunch of silver from, and more recently, I say the past couple of years. But I don't know, guys. I don't put everything in one basket. I spread across a couple of different ideas. I buy a whole bunch in the really cheap stuff, and if it's super low risk like physical metals, then you can just load into it. You can put six-figure amounts in it if you want, or seven figures or eight figures. I don't know how much money you guys have, but it's a low risk, good opportunity here. Another one from Buffett. He says, this is the quote: "Life today is better." I already said that one last time, so I'm going to leave it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. The website's got that special coupon code that's still active if you'd like to join. And that's all I've got. By this time, I would have uploaded the Sunday Q&A session, so that's uploaded to the website. Go check it out if you want to see it. And that's all I've got. So we'll catch you next time. This is Finding Value.